Hello and welcome back to my channel. My name is Max and it's time for me to provide an update about the state of the Australian and the world economy and to make some observations about financial markets while I'm at it. So welcome back. So firstly, I just wanted to touch on the macro picture. A lot of attention has been placed on China of late, and that's for good reason. Firstly, they do supply a lot of the world's goods, particularly for the Western world. In fact, the US has been described as a Chinese outpost of late. They're also a massive buyer of raw materials, and this is particularly significant for Australia in terms of iron ore. And in addition to that, many large investment firms and banks throughout the world's financial system are holding corporate bonds in Chinese companies. So a lot of Chinese debt is propping up investment firms and hedge funds, and even in the cryptoverse, stablecoins like Tether. There's a lot of speculation that there's a lot of Chinese junk bonds on their balance sheets. So over the course of the last half century, China's economy has grown significantly, and their real estate industry in particular is quite overvalued on a global scale, particularly with reference to the average wage of their citizens. However, the Chinese Communist Party have begun coming down hard on several sectors of the economy, leading to massive drops in stock prices for large Chinese tech firms such as Alibaba, and now a string of property developers such as Evergrande. They are staring down the barrel of a liquidity crisis. This could present a massive contagion threat to the world economy, and the Evergrande revelations resulted in brief bearish pressure on financial markets during the month of September. If Evergrande or other large developers in China are unable to meet their debt obligations at some point, it could not only result in a collapse of the value of Chinese real estate, but it would cause a liquidity crisis for firms holding Chinese corporate bonds, and that would then ripple across the financial world. Meanwhile, demand for Australian raw materials such as iron ore could be severely reduced as well. Many of you may also have noticed talk of inflation or interest rate rises in recent weeks and months. The USA so far in 2021 has been experiencing persistent inflation, as well as a lot of supply chain issues and labour shortages. As a result, their central bank, the Federal Reserve, has begun tapering their bond and mortgage-backed security purchases, but they have not committed to an official interest rate rise yet. Meanwhile, in Australia, the Reserve Bank were stubbornly committed to yield curve control and maintaining the official cash rate at 10 basis points, but bond traders managed to push the yields up well beyond 0.10, and the RBA were actually forced to abandon their yield curve control, raising expectations that interest rates will rise well before 2024, which was their original target. In response, the Australian major banks have already hiked their interest rates on both fixed and variable mortgages, raising concerns about the ability of Australians to service their mortgages as inflation begins to take root here as well. So I'm going to focus on Australian property, but I will quickly begin with a note on the effective collapse of Zillow's house flipping game in the USA, where the company attempts to make quick profits in a frenzied housing market, despite pricing out the other buyers. So essentially they pay a premium and then attempt to sell the house on for profit within 3 to 6 months. Seems like that game is over. They've dropped out of it, they've lost a lot of money, and there is a lot of speculation that that represents the top of the US housing market, for now at least. However, here in Australia, we're also seeing signs of slower growth, so not reductions in price, but slower growth after the summer and autumn frenzy, and that seemed to occur both in the major cities and in regional centres, and even in rural and agricultural land sales. More stock is expected to enter the market as sellers attempt to beat interest rate rises, which have now been confirmed by all 4 major banks, as we mentioned before. Buyers may also be a little less inclined to bid up prices out of desperation as a cooling market combines with tightening lending conditions. Quick word on stocks. Wall Street remains at all-time highs, while the ASX 200 in Australia remains in a sideways trend in and around the index's own all-time high at about the 7,500 level. Just going back to Wall Street, one concern I have is the volatility index, known as the VIX, appears to be resting at long-term support and is also consolidating towards the end of a long descending triangle pattern where a break to the upside is favoured. As we can see from this chart, the VIX and the S&P 500 tend to have a fairly strong inverse correlation, i.e. when the S&P 500 goes up, the VIX goes down, and vice versa. The bond market has rallied in recent weeks and driven yields down, favouring the tech sector, which has been led by the gravity-defying Tesla price in recent weeks. However, rising bond prices generally coincide with a bearish stock market. Even the DXY currency index appears strong, with October's highs briefly cleared this week, while we currently trade well above support, and the AUD, the Aussie dollar, has been thus far unable to clear resistance above the 75 cents level. We also had the first suggestions of tapering from the Federal Reserve last week, and with margin debt at all-time highs and several indicators revealing bubble-like risk in the stock market, there may not be all that much room to run left in this bull cycle. So it would appear that there are several headwinds existing on a technical level for Wall Street, but this week's open at least has been fairly flat so far. So we'll see how that plays out. I don't think we're in big trouble just yet. I think there's more room to run, but as I say, there does appear to be some sort of bubble forming, and a lot of commentators are in agreement over that. Regarding metals and commodities, the lean returns of 2021 for the precious metals continue, although a decent recovery from the August lows has been observed on both gold and silver. This is despite increasing inflation expectations. Although having said that, the prices do continue to stay elevated above pre-COVID levels, probably due to the massive increase in the M2 money supply. Perhaps the health of Wall Street and the rise in speculation on more risky markets such as cryptocurrencies is also denting inflows into the precious metals for now. Energy futures have had a stellar 2021. Most recently, natural gas and Brent and crude oil have been the main beneficiaries, as I'm sure some viewers would have noticed when filling their car with fuel in recent months. Coal also saw a meteoric rise, but futures have fallen significantly as China makes efforts to restore production and more typical prices. Having said that, the Northern Hemisphere is approaching winter, so we may see increased demand for such commodities. Of significance to Australia is the continued decline in the price of iron ore, possibly linked to China's continued attempts to diversify supply away from Australia, as well as concerns over future demand from embattled property developers for steel. So just onto cryptocurrencies to finish. Since my last update in the Australian winter, we had cryptocurrencies consolidating after a really big fall. The price of Bitcoin dropped from about 65k US all the way down to sort of 28.5k. So more than a 50% crash. And other assets, Ethereum, Polkadot, Cardano, had even bigger falls in price. But since then, the market has recovered, and the market leader Bitcoin has recorded a new all-time high. The market dominance of Bitcoin did rise towards the 50% level, but renewed speculation in meme coins such as Shiba Inu and the continued growth of Ethereum has halted this advance. Other large cap altcoins saw important milestones that have pushed prices to greater heights. Most significantly, the implementation of smart contracts for Cardano and the announcement of parachain auctions beginning on the Polkadot network. And other layer 1 cryptocurrencies such as Solana have made big moves over the last few months as well. Having cleared the 65k level in October, Bitcoin was able to decisively prove the market cycle did not end in April, a contention shared by many pundits at the time, and hopes of a 100 to 200k Bitcoin peak have been renewed, although it appears unlikely that the market cycle will end in late 2021, as predicted by many. So to conclude, most markets still appear to be in a bubble of some kind. The overvaluations appear particularly stark compared to the state of the global economy, but maybe not quite so much when you consider the rise in the money supply and the cheap credit available. I would imagine the reckoning will eventually come as central banks are forced to reduce their monetary expansion and fight inflation, and as we are seeing in China, this may expose some highly vulnerable sectors of the economy. But I do believe we have high to go in most markets before that point. Happy investing, and thanks for watching. See you later.